Give me a limitation. There's 1, 2, 3, 4, 5. There's 6 you can choose from. Give me one of them.
Normalised earnings.
Okay, normalised earnings. Thank you. So, what are normalised earnings? What are they? You've told me that normalised earnings is a limitation, meaning that it skews or it sets a parameter on what people can see. So, what is a normalised earning then? Do you want to go 2 for 2?
It says unusual influences from the balance sheet, but I don't really get it.
Okay, so. Okay, so it's that they remove those one-time or unusual sales, okay, figures. They remove a one-time or an unusual, bit of money they make basically that could skew. So in your balance sheet, and this is normally related to the balance sheets, the RE balance sheet. Okay, so for example, the business might be sitting on quite a large parcel of land that they're not using, they're never going to use, and they need money. Okay, so if they were to sell that land, that might be the one and only time they're ever going to have anything of that much value to sell. Okay, so when they sell it, let's say they sell for $20 million, if they were to put that into their balance sheet and say, this is how much money we've got from that, and then the following year, they don't have any land to sell, and the year before they sold the land, they didn't have any land to sell, all of a sudden it makes a little bubble in their value. So, through normalised earnings, some businesses remove those one-time or really unusual payments in order to avoid any sort of ups and downs in their financial reporting. The very last limitation, so limitation number 6, is basically adding footnotes to your financial statements. Okay, so that one there is basically you put a little asterisk next to your balance sheet or your revenue statement and say, we use this method to calculate, or we removed this one-time thing from our balance sheet. So people can still know. So they're not hiding anything from anyone, but they're obviously not also making it very clear in terms of how much they're truly worth. How much? What's the next one? What's another limitation? What's another limitation of a financial report?
Timing issues.
Okay, that's another one. Yeah, good. As I said, it doesn't matter what order we do them in. Doesn't matter what order we do them in. I just want to get them done. It's a really bad arrow. Alright. What's the issue with timing issues?
Time.
Yes. The issue with timing issues is time. In what way?
That the reports only cover a certain area of time, may not be like a true representation.
Perfect, thank you. So reports basically cover a set period of time. So what it might not do is take into account the seasonal fluctuations. So Christmas, Easter, Valentine's Day, Mother's Day, winter, summer. So because the reports again cover a set period of time, okay, might not take into account seasonal fluctuations. Alright, what's another limitation of financial reports? We've got 2 out of 6 so far. Capitalising expenses. What does this one do?
Well, it's an expense, but it's ended up used as an asset as well.
Yeah, exactly. So basically, it's an expense, but they're basically just flipping it around and saying, we're going to class this as an asset instead of an expense. Okay, can you give me an example of something that might be? So, if it's an expense, okay, they've spent money on it, and now they're going to capitalise it. Okay, what did we just say capital meant? Or one form of capital was, other than money?
Machinery.
Equipment, machinery, something that produces something else of value. So what happens in the idea of capitalising expenses is they may have bought, let's say they're a fish and chip shop, they spend $20,000 putting in the kitchen fit out, okay, Bain Marie, fridge for the drinks or whatever. Rather than saying these are expenses, these are things that we spent money on, yes they are really things they spent money on, but if they flip around and then capitalise them, they say, but they're going to produce things of value for us because without them we can't sell our products, so we need them to then make money. So rather than classing them as expenses, they're classing them as assets instead. So they're things of value then for them. Okay? Research and development is also a great example. Okay? So another example, R&D. Yes, it costs money to research new products, but without developing new products or new ways of making those products, you can't make money. So businesses might say, well then, we didn't really incur an expense, we've really added an asset because we're then going to use whatever we've just discovered or researched to then make money later on.
Wait, what's R&D?
Okay, research and development.
Wait, so is capitalising expenses like the machine that Krispy Kreme used to put the glaze on top? Like, is that...
So they can capitalise that. So rather than saying we spent $1 million buying a machine that glazes donuts, and then say we've spent money on it, we lost money on it, whatever, they might then capitalise it and say, but without it, we can't make our signature donut, which is an original glazed donut. So rather than saying it's an expense, they'll say it's an asset because without it, we can't produce our product. We can't do anything with it. Give me another one.
Valuing assets.
Okay, valuing assets. Alright, what's that all about?
Well, they look at, I don't know if it's competitors, but other businesses that have similar products and see how much they're selling them for.
So not some, okay, you're on the right track. You're on the right track. Not so much how much competitors are selling things for, but how much they're valuing their items for. Okay, so again, we're looking at pretty much okay. There are some things you really can't put a finite number on. Okay, things like the amount of stock you've got, you can put a number on that. Things of how much credit or how much debt people owe you, you can put a number on that. Things like how much cash you've got, you can put a number on that because you've got a piece of paper that says this is how much we've got. But there are some things, for example, like machinery or vehicles, that once you've used them, what tends to happen to them as a value? It goes down, it depreciates. Okay? Now, there's no real way of them figuring out how much it depreciates or how much it will then be worth at the end of this year or next year or whatever. So that's when they then find a way of estimating how much their assets or even their liabilities are worth. Okay? Now, there are a few ways they can do this. Okay? One is that discounted cash flow method, which is looking at, okay, we predict that it's going to lose this much money of value every month or every 3 months or whatever, and then by the end of the year, this is how much we think it'll be worth. Okay, so we bought a vehicle, we bought a van to transport beds around or whatever they might be selling. We paid $60,000 for it. By the end of the year, based on depreciation, based on running costs, that sort of stuff, we might be able to say it's worth this much by the end of the year. Okay? Another way they can do it is, as you said, they can compare against competitors and sort of see, okay, well, what is everyone else saying it's worth? Other people that have bought this exact same fan for the same amount of money, how much have they said it's now worth? And they can sort of follow the same thing and say, let's now use their idea. So it doesn't really, in your balance sheet, it won't really give you a really solid number. So you might say $20,000, but that doesn't mean it might actually be worth $20,000. That's just how much they think it's worth. And if they go to sell it, they might not get $20,000 for it. Because by the time they sell it, more depreciation, they might only get $10,000 for it. So that's why this, again, skews a bit of the results in terms of how much things are worth and what method do they use to value. Do they just take a guess? Or have they gone against other companies and said, this is what they're saying it's worth, so we're going to do the same roughly? Or, we might travel more than them, so we'll make it worth a bit less, but it's obviously being used a bit more, etc. Okay? All right, one more type of limitation and then a little half one, which I've already spoken about a little bit before. What's another form of limitations of reports?
Debt repayments?
Thank you. Debt repayments. Okay. So one thing is they can't really, can't show certain information. Like what kind of information can't they show when it comes to the debt they show on their balance sheet? What kind of information can they not show? Not because they don't want to, but just because they don't have the space to do it. So if on their balance sheet it says that they've got a $100,000 mortgage, all you see is that they've got a $100,000 mortgage. But what does that not show though? All it shows you is a figure, okay, quantitative number, okay? But what else does it not show you?
Like where our money went.
Say it again?
Where the money went.
In what way?
I don't know.
Is it like how much they're like per month they're like paying back?
Okay, so one thing it doesn't show is their repayments, so how much they're actually paying back every month, which might not seem like a big deal, but if they're only paying back $1,000 a month, that sounds like a good deal if you're going to invest in them, because you know that they're going to be able to budget a bit better, as opposed to a business who's paying back $10,000 a month. Are they going to have enough money? Are they going to generate enough cash flow to cover that payment every month? What else might it not show that might still be a limitation on this report? And this isn't just how much debt they owe, this could also be the debt that they're trying to collect back as well. It doesn't show how long they've had that debt for either. That $100,000 mortgage on a balance sheet, they may have had it for the last 50 years because they just never pay it back, because every time it comes close to paying back, they just redraw more money on it and say, you know what, we're just going to add some more money to it. We'll take out a bit more again. So it doesn't actually show you how long they've had it for. It doesn't show you how well they've actually been able to pay their debt so far. It doesn't show you if they've had any payments knocked back or any defaults on a payment. You know, that $100,000 mortgage, you might, oh, that's a very low mortgage, that's great. But there's nothing that says, by the way, for the last 6 months, they've not paid back the bank because they're struggling to have enough cash flow to do it. Okay? So, while you can put down the number and says this is how much money they owe, there's a lot of information missing in terms of how long have they had the mortgage for, how long have they been paying it for, how much are their repayments, do they have enough money to make that repayment? Okay? And the last one, which is sort of like a half limitation, but it helps make all these other limitations a bit more clearer. What is it? I already did mention it.
Footnote. The footnote?
Yeah, the footnoting. Okay, so notes to it. So at the bottom of a balance sheet or somewhere in the accounting, there'll be something that basically says, this is what we've done for this statement. It says this, but we also sold a $2 million bit of land, but we didn't include it just to avoid skewing the results up and down. Or we've got all these cars, and the method we used is the guideline company method, which is we looked at what other people are doing and we went with the same thing. Okay, so basically a little footnote, a little bit of information, a little asterisk. Okay, that says this is how we calculated everything. This is what we did, just to make all of this a little bit clearer